Activision Blizzard is still in the middle of the potential Microsoft purchase. Now, Activision Blizzard just the other day announced really terrible revenue and profit. So does that affect the Microsoft deal? I don't know. The deal from Microsoft is $95 per share. Let's look at our software and see where the stock is currently. So we go to our software. And again, if you are a subscriber of our software and our community, first off, you're brilliant. And secondly, follow along. So the stock is currently at $79. So there's still almost 20% upside. Now, keep in mind, Warren Buffett is making a play on this deal. His comment is, I don't know if it's going to happen or not, but Microsoft has a whole lot of money and they're paying cash for this. So he's making the play that it's going to close. I don't know if it's going to close. Did these recent revenue drop and earnings drop affect the deal? I don't know. But they're currently at $79. Here are 3 things I want you to remember in this deal. First off, will Microsoft buy this company? That's the first thing. Are you doing this as a value play, as a long-term play, or as a complete arbitrage on the deal? Number 2, if Microsoft does not buy Activision, will I still want to own the company at today's price? That's what we're going to do our 8-pillar analysis on, and you have to do some research on there. And if you're part of our community, have that conversation. Because I look at $79 versus $95 close price and say, people are betting it's not going to happen. That's what I see when I see that. Number 3, if again, they are not acquired, is the pipeline of games good enough where I feel comfortable owning this company for the future? A big reason they fell in revenue was the Call of Duty franchise had a bad quarter. Call of Duty's huge. My guess is Call of Duty is not done yet, but they still have to sit there and produce results in order to get more. But just like a drug company with some sort of drug, I want to make sure that the company has more streams of revenue than just one good franchise. So let's go take a look at the company right now. If you like what I've said so far, I'm Paul. I'm a value investor. It's very simple. What I do is I look at every investment as the present value of all future cash flow. My goal is to learn as much as I can, because the more I learn, the less I'll fear. When I buy a company, because I've learned a lot about it, when the stock price drops, I do not fear it. I look at it as an opportunity to buy more. And I also don't look at a stock price drop as a reason to buy. It's a starting point to take a look. But if the numbers don't make sense, my goal is to still avoid and find 20 or 40 companies where the numbers do make sense. So let's go into our software. So here's our main page of Activision. Some high-level items, $62 billion market cap, current PE of 25, 5-year PE of 36, very healthy margin. Gross margin of 73%. What's gross margin? It means every unit they sell extra has 73% of that going to the bottom line. Very small dividend, 0.6% that pays out $365 million. And this is their free cash flow last year and over the last 5 years. They can easily afford this free cash flow, this dividend. Their free cash flow only pays out 15% in dividends, so we're good there. So, pillar number 1, we want the 5-year PE less than 22.5. Right here, 5-year PE, 36.5. That's an X. Okay. Pillar number 2, we want the 5-year return on invested capital greater than 9%. Right here on the main page, 9.2%. Check mark there. That means they do a good job of investing the money that is in their business through debt and equity. Pillar number 3, very simple. I just want revenue growth over the last 5 years. I don't even care if it's $1. I want revenue growth. So I go to the income statement and look at the top. 5 years ago, 7.26. Last year, 8.3. Check mark there. All right, so they're driving revenue. Pillar number 4, I want net income growth over the last 5 years. Again, just $1. So I scroll down just a smidge. Net income 5 years ago, $346 million. Last year, $2.4 billion. Check mark there. Now, big jump, but look at the years before and after the 346. So something happened here that caused a short-term aberration in profit. Pillar number 5. Now, this is one if you're new to the channel especially, pay attention to. We want to make sure they're not diluting us as owners by issuing more and more shares. Now, does issuing shares all the time mean it's bad? No. But if I buy a company today and they issue more shares, I'm being diluted as an owner. This is not a stock split. This is just I'm issuing shares for money. I am being diluted. I'm getting less and less a piece of the pie. So we scroll on to the bottom of the income statement and look at the very bottom. Now we go back to the end of 6 years, which is 749 million shares, and last year 780. So they definitely diluted their owners. Again, not necessarily a bad thing, but just in general, I want to see that number going down, especially on cheaper companies. Now, pillar number 6 has to do with debt. Guys, debt works the same for you as it does for companies. The more debt you have, the more debt a company has, the less likely they are to do well during bad times. So what's a good amount of debt? Well, let's go back to our main page. What I've decided for me is I take their 5-year average free cash flow, $2.04 billion, and I multiply by 5. And that equals $10.2 billion. So I want less than $10.2 billion of long-term liabilities. All right? So we go to the balance sheet right here. We scroll to the bottom, and long-term liabilities are $4.89 billion. That's awesome. So they can pay off their liabilities in under 2.5 years, their long-term liabilities. Now, pillars number 7 and 8 have to do with free cash flow. What is free cash flow? Free cash flow is cash from operations less your capital expenditures. And there are 5 things you can do with free cash flow. You can buy back shares, pay down debt, reinvest back in yourself, make acquisitions, or issue dividends. You can do any of these 5. You can do none of them. You can do all of them. It doesn't any combination of such. So we go to our cash flow statement. We scroll down a little bit. Now, guys, I wanted to make the math easy. And guess what, guys? If this seems confusing to you and you're new to this channel, we have one more tab to look at that does all the math for you, but I want to explain to you the whole entire process. But here is the free cash flow. Cash from operations less your capital expenditures. We added this line to make the numbers good, easy for you. Now, actually, guys, we had a drop here, 2.17 to 2.14. It's a slight drop, very inconsequential. So it is an X there. And finally, we use the free cash flow to determine a value of the company, much like PE. We want to use a price to free cash flow ratio. So we take this 5-year average free cash flow, and we multiply by 22.5, the same 22.5 we looked at in PE. So 2 times 22.45 is $45 billion. If you remember, the company's on the main page, the company's market cap was $66 billion, I believe. That's an X. So we wanted the market cap being under $45 billion. But like I said to you, there's a shortcut to all of this mess. 8 pillars tab right here. It shows you all the X's, the check marks, and everything like that. So we're sitting here. The valuation metrics are terrible. They've increased their shares slightly, and cash flow has declined. Now, this in and of itself does not mean you should avoid the company. Remember, every investment's a present value of all future cash flow, but we don't know the future. So our goal is to make assumptions about the future to determine what we should pay for today. That's why we have the stock analyzer tool. So before we get into that, you've seen a lot on the software. You've seen this community. We've seen the chat. This is a very important aspect to investing. When I first started investing 25 years ago, I was alone. I had nobody to talk to about this. I was a nerdy high school kid, and I just kept it to myself. And as I became a value investor after being burned in the dot-com crash, it became very lonely out there. I was like, listen, this doesn't make sense to me. But now we have the internet. And that's why we created this software. We created the software purely to help investors be around like-minded people. Over 13,000 people have signed up for the software since we started it 2 years ago. And there are thousands of people active every single day in this community talking about all types of investing, including crypto, Tesla, and things that I don't necessarily believe in. There are a lot of independent thinkers in here. I get challenged all the time. People are always asking questions. And all they do is pay less than a cup of coffee per day to get this software. It's a no-brainer, guys. The big key to investing isn't just getting big gains. It's also having the right mindset and avoiding the big losses. If you can avoid 1 or 2% of losses a year and even increase your gains by 1 or 2%, this will lead to possibly millions of dollars extra in retirement, depending on your situation. So guys, if you're serious about investing, go to everythingmoney.com or patreon.com for our international users. Less than a cup of coffee per day. You get the software and everything that's coming with it. Look at all these tools up here. You even get the watch list, all the coming soon. You get the watch list where you can put the stocks you want at prices you want, and the software and app will notify you. Go right now, sign up. So, stock analyzer tool. I'm going to do a 10-year analysis. You can do 1 to 20. This tool alone is worth the entire software price. So when it comes to revenue growth, so this is assuming we keep the company and Microsoft does not end up buying the company. I'm going to go with 2, 4, 2, 5, and 8%. 2% of it do okay, 5 they do about what it's supposed to do, and 8 if they get another awesome franchise along the way. Profit margin. I'm going to do 20, 22, and 24. Free cash flow margin, I'm going to do 23, 25, and 27. PE, guys, 13, 15, 17. 13, 15, and 17 on free cash flow because 25 it's not a reasonable, I'm sorry, I can't pay 25 times earnings for a company that doesn't have major growth potential. And finally, for desired annual return, again, I'm going to do 15%. Why? Well, 12.5% I usually keep for very big companies that I understand how they make money and the revenue is very consistent. This has a lot of fluctuation. This is a lot of unknowns. So I'm going to put 15% in there. I'm going to hit the analyze button. Now remember, guys, if you like this stock analyzer tool, please rewind and rewatch it if you're a little confused, because it's a matter of doing it over and over again. Once you hear it over and over again, it'll become ingrained in you and you'll understand more and more how to look at these. I make assumptions based on the past and based on what I perceive the future to be. Am I too conservative at times? Absolutely, but that's my goal. Once I hit the analyze button, which I've already done, 6 numbers are going to pop up. If they're all green, doesn't mean go out and buy it. It means make sure your assumptions were actually correct and do research on that. If they're all red, but close to this price of where it's at today, 79, maybe do more research. That way you know the right price to buy it for, and you can add it to your watch list. So, analyze. It's all red. And guys, not even close. A low of 20, a high of 45, middle price is 30. My personal opinion is I'm waiting until it falls big time if the Microsoft deal doesn't happen. Thank you very much for this time. And if you're more interested in this process, go watch the next video on the 8 steps to analyze a stock. Thank you very much.